Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to the next episode of the Physician Sense Podcast. I'm Tyler, and I've got the Sunshine State dear friend and excellent financial planner, Chad Chubb. Glad to have you here today. Glad to be with you.
Thanks, Tyler.
We're going to talk about investing today. There are so many ways that a conversation about investing can go. So if you're listening to this and you have a specific question about investing, please post the question on our website, physiciansense.com, or reply on our YouTube page under this video, and we will address it. Today's episode is going to be a high-level discussion of the basics of investing, and that way we have a good starting point. Usually we don't have to do many disclaimers on the audio side, but when it comes to investing, as fiduciaries, we both felt compelled to remind you all that the investing topic that we're going to discuss today should not be taken as investment advice for you or anybody else. This is purely education to help you to understand how investing works, and then you need to take the steps to be able to apply it to your own situation. But investing is super important, and so that's why we're talking about it today. And if you could think of like one sentence to say why investing is important, Chad, what would you say?
I would say start now, because to me, investing, when you believe in investing the way that you and I believe in investing, and great intro. I know you and I joked before we got started, my compliance team will be very happy with you. So thank you. Start now. It's one of those topics that you feel like you can always, well, I'll do this and then I got this and I got that. And the most powerful tool in personal finance is compounding interest. There's no magical sauce to that. I say this to every current client. Clients have been with us for over a decade now. People that are just sending us a note on YouTube, just get started now because of compounding interest. And that is really, I always just say, diversified, low cost, controlled your emotion. If you can do those three things while matching that diversification bucket to your needs, your own risk tolerance, if you avoid all headline news, you should be in a pretty darn good spot 10, 20, 30, 40 years from now. And I just feel like so many people, physicians, probably have a little bit of extra oomph here. Just, I think that the nature of kind of keeping up with the Joneses and what are they doing? What am I doing? But just get started. Compounding interest is the most powerful tool we have. And usually when it comes to investing, we're just trying to keep it high level at the start. I always will plug in compounding interest. And I know it's probably an overused word, at least maybe in our world, but it's that simple. It's just getting started, getting something into an account, letting compounding interest do its thing. But that's usually where we get started in the terms of, dabbling in investing.
I saw a screenshot of a tweet that Morgan Housel made back in, I think it was 2017. And it was something like about, pick an effective title of a book that you would like to write or something like that. And his idea was, the title was, Shut Up and Wait. And every single page was just a picture of the stock market over the past 100 years. And of course, we don't, intend to be crass about the emotional aspect of investing, because when we put our money at risk, we all feel anxious to some degree. But what we want to be able to impress upon you is that our own ability to guess what is going to happen and trying to be, whether you call it, clever or fancy with our investment strategy, is a waste of time, because the future is something that nobody can know. And so trying to pick something that will allow you to just be consistent and then just autopilot this thing and then just go do something else, because we can't outsmart the markets. And we want to be able to to get things started early, but then put it to rest and don't try to overthink it. It's funny too, because the percentage of time that I know in our practice that we dedicate toward investment strategy and management is not high. Like it's like you need to dedicate the space to it, but there's a lot more time intensive things that need to be addressed than investing, because the investing is best positioned if you set it and forget it.
Yeah. I describe it that same way all the time. Say most clients come to us hiring a financial advisor saying like, you're going to help me with just my investments. And to this day, I think the physician community is actually one step ahead here only because of how much they do get into the weeds on certain topics where they do expect a little bit more, at least the clients coming to us have a better understanding of financial planning versus investment. But I think the broad stroke of the brush would say most people still think a financial planner only does investments. And I'll say all the time, investments are one of the more simple things that we do. No matter how easy I tell you it is, most clients, most physicians are still overwhelmed by it. And I just say it's not that crazy. It's more organized now than ever. Even if you don't want to do it on your own, you can go use the Vanguard PAS system for 30 basis points. You have this robo-advisor here, this robo-advisor there. And really, you're just trying to automate something to give yourself more time back. And then you add in the pricing wars of all the custodians, Vanguard versus Fidelity. Now Fidelity's at 0, Vanguard's at 0.03. These are all good things for us as end consumers of investing. So there's been a lot of good wins in that side of things, but it is, for most advisors doing true financial planning, it's one area that we probably spend a lower amount of time on than most would expect. And I usually come back and say that, our biggest value add over time is probably on the tax planning side more than it is the investment side. But you and I also get started with clients younger. So I think it's a little bit easier there, where if I have a physician that joined me at 55, but for the last 2 decades, he was in 1.4% mutual funds, or she was in, some crazy annuity where she's just getting crushed on fees. Well, the overall savings might be a lot going forward now, but with the pricing wars in there, with, I think the benefits of some of the physician bloggers, I'm going to throw White Coat Investor out there in terms of like modern portfolio theory, keep the costs low, control your emotions, you'll be in a good spot. I think those have been very important steps for everyone. I'm going to say the physician community because those are our people that you and I work with. But in general, a lot of good things have come with the modernization of investing as well.
Yeah, no, you're right. Yeah, I think we have to make sure that it's simple. I think another thing too to note here is that it is simple fundamentally, but for any of you who have your head full of medicine and you find investing stressful, I want you all to know that makes sense too. And the anxiety that you might feel about well, I don't know what to do. I don't know how to do this on my own. I need help. It's okay to get help, and it's okay for it to feel really hard for you. When we say it's simple, we're talking about the fact that once the what to invest in and how much to invest in is known, and that of course is of great value that people like us can, have learned over the years. But once you know that, and for anyone that has gone through that threshold where they're like, okay, I know what to invest in and how much. And then it's oh, what do I do now? Oh, nothing? Oh, I don't do anything. That's the simplicity that we're talking about. And so, don't feel like, there's something wrong with you if you find investing stressful, because it very well can be. And what we wanted to do with the time that we have remaining for today is to give you a basic foundation of what investing is so that you can understand what you're getting into. I like to describe investing as optimism in humanity, because ultimately successful investing means that your money has grown. You've put money into companies that provide services and products that we all use. And when we give our money to those companies and become part owners of those companies, we are optimistic that they will continue to grow, that they will make profits, that they will sell their products and services, and that we as consumers at large, we will buy from them. And that the products and services that are being offered are for the benefit of humans to be able to continue to live, to be able to make advancements in technology, to create new sources of experiences as well as conveniences to improve quality of life. So if you invest and it is successful, it is because we cumulatively have all done that. And that is optimism. Mm-hmm. Now, there's a lot of bad things that happen in the world, and there's, the news is always geared toward the bad things that are happening. And so it can be difficult to feel like, well, why would I be optimistic? There's going to be, there could be economic downturns. There could be a depression. There could be job losses. There could be war. There could be all sorts of things. And those are all true. But if you look at any sort of lengthy time frame where you can see a graph that shows what has happened with the stock market over decades, all of those bad things, examples of those bad things have happened throughout those timeframes, but the stock market grows anyway. And it's because there are opportunities and that people generally, they want to live and they want to take care of themselves. They want to make a life for their children and their grandchildren. We all want that. And that impulse naturally drives economic growth into the future. So by investing in spite of fear of bad news and in spite of concern about what the future will bring, it is falling back on the general concept that, do we want to take care of ourselves? Yes. Do we want our children to be able to have what they need? Yes. Do most people want that? Yes. So investing is committing to that optimism. And so that's why we encourage everyone to do it, because it's going to happen anyway.
Yeah. I mean, that's a beautiful description of investing. I mean, sounds fantastic. I mean, who doesn't want to be a part of that? And, owning a stock, even in a more simple form, owning a stock is you own a piece of a company. Now, you buy one company, you hold all the risk of that one company, which is why usually you'll see individuals like myself and Tyler saying, hey, we like something called an ETF, an exchange traded fund, or maybe a mutual fund. And if these are new terms to you, the reason why we like those is because instead of one company, you might own 500 companies, right? Let's just say it's an S&P 500 ETF. You could own 500 different companies inside of this one investment vehicle. And that's neat. That's important because there could be really bad news about company 17, but the other ones are all fine. And that's where it's really important to stay diversified in terms of stock investing. And, as Tyler noted there will be bad times. There certainly will be. And there's a lot of volatility that can come with that. As we're recording this, we're in an election year. I would say historically, election years have more volatility, especially once we get right around primary season. It doesn't mean that the market's going to go up a lot or down a lot. And actually, historically, the market has said that. It actually doesn't really go one way or the other, but there is more volatility, or it might be a little bit more range bound in that volatility. But you have to understand that coming into it. Tyler, this is one thing I think that's very unique to the physician community is when we have physicians that are in the United States on visa, I will usually take a more conservative view in terms of investing because I'll say, have you ever experienced a stock market decline in the US? And a lot of them will say, no, this is all new to us. We're learning all this from you and from Tyler and this blog and this YouTube channel. Like, I don't even know what that means. And it's not even knowing what it means. It's feeling it. And having $10,000 go down to $5,000 when that's your life savings at that point. It doesn't matter how many times Tyler and I just say, hey, just stay calm. It'll come back. You'll be fine. That's not easy. That's hard. And especially if it's your life savings, if you're like, this is money, for my kids or for my parents. And there's a lot of emotion that comes with investing. So, Tyler, you said it great earlier where, we say simple. We're just talking about the platform of simple. Investing is highly emotional. And that's where controlling those emotions and understanding that there's going to be really good times. There's going to be really bad times. You need to prepare yourself for that. No matter how simple we say the portfolio is, even these simple ETS portfolios, they still go down, right? If you're heavy in equities, you're going to still have a lot of volatility. And that's something you really, if you're catching on to this and you're in your first intern year or your first year attending and you're just getting into investing, like these are really important things to keep in mind because it has a lot of emotional ties to it and it will forever. And guess what? When you make even more money and you invest even more money, one of my favorite things is when clients are like, Chad, I'm down 6 figures. Like, yeah, it's only 2%. The problem is you have a lot more money invested now. 2% on 1,000 versus 2% on 1,000,000 are different emotional levels, even though it's the same 2%. So not only is it hard at the start because you're just getting started and in the middle because the numbers are getting bigger or at the end because the numbers are really bigger, it's emotional. There's a lot of moving parts that come with investing. Again, the good, the bad, and the in-between, but you need to prepare yourself for that.
Yeah, no, good advice. Yeah. And like having this is kind of veering into investor behavior, so I'll be quick about it, but maintaining a strong emergency fund, having the right insurance policies, are fundamental to good investor behavior, so that when your investment accounts do experience that sort of a drawdown, your inclination, while still stressed, will not be asking yourself, should I sell? Because you know that you've got emergency savings and you know that you've got insurance policies that will protect you in the event of disability, for example, or any sort of liability at work or home or your car, because you've got an umbrella insurance policy. So all those things, they are interrelated and will help you to be a better investor. So if somebody is going to, like, say someone is going to, they're finishing up training, say they just finished this year, and their employer is offering they've got a 403B plan, and they've got a series of Vanguard target date funds. And then they also have a variety of Vanguard index funds and a couple others in there, like Invesco or Dodge & Cox stock or Dodge & Cox income fund, for example. What would you like? How should a person approach those choices? Because they want to understand the basics of investing. So, what would you tell them?
Yeah. It's funny because that's a really good example, because even when clients come to us for a one-time plan, we'll always present two options. So if someone comes to a one-time plan, we usually assume that they have some decent investment knowledge, but we still give them two routes. It's usually a simple 4 or 5 fund index fund portfolio. Or if you look at that and you say, oh, I don't know, Chad, like buy, sell, rebalance. What is all this? We're like, target date fund can still do the trick. I always say target date funds are not my favorite. They're not the sexiest, but again, an industry that is ripe for a lot of innovation, target date funds are one of the better innovations we've had in a long time if you just look at the psychological effects of a target date fund. And in simple terms, a target date fund of, let's just say 2060, I'm picking one way out there, would say, hey, we're going to build this allocation at Vanguard. Fidelity has them, Schwab, everyone has a target date fund. And 2060, that's when we assume you're going to retire. So by the time you retire, we're going to have a portfolio that is much more conservative. Oddly enough, I usually say it still ends up to be right around like a 50-50 mix. It's still not like a cash portfolio, which is good because you need that money to last now through all your retirement, which is why we say you can't be too conservative. But a target date fund will start off more aggressive and then over time slowly lower your allocation to stock so that by the time you hit 2060, it's not as aggressive. So if you're watching this and you're like, I don't want to learn all the fancy parts, a target date fund can be a good plug-in there. Now, if you're working with an advisor or you're just starting to learn this on your own, I do like the idea of a little bit more custom allocation, because the problem with the target date fund is it's saying, hey, we assume all of society should be in this allocation and slowly glide this way. There's no customization for you in both good and bad. You could say, I don't want any bonds. I want to be all equities. Most target date funds, even your furthest ones out there right now, still have about a 10% allocation of bonds. You could come in there and say, I don't want any bonds. It could be the exact opposite. You could say, 2060, there's 90% in stocks here. I'll have heart palpitations if I watch this thing bounce around. So that's the one downside in target date funds. It's not customized for you. So I think for many, Tyler, getting back to your main question there, without any investment knowledge or still learning the game, I think target date funds are fine. I think they're a really good innovation in there. Again, keep an eye on fees. Vanguard target date funds are usually pretty good. I get a little bit nervous when I still see some of those target date funds that are still like 30, 40, 50 bips. I'm like, what's happening right now? If they're more comfortable, I'm a fan of a simple portfolio, a 4 or 5 fund portfolio, getting most of the US. I'm going to call them mid caps, large caps, small caps. We won't nerd out too much on that. Some international exposure in there. That's a pretty good looking portfolio to me. Now, again, the balances, all that depends on a lot of personal questions, but that's usually how we approach it, at least in that broad stroke of the brush here. How about you?
So one thing I wanted to mention this too, because a lot of people ask me this question because they want to understand how to distinguish, like, what's the thing to look for? And you'll hear us say things like basis points or bips. Basis points is referencing, like, 1 basis point is 1/100th of 1%. So something that if you hear someone say 150 basis points or 150 bips, They mean a 1.5% annual fee that is charged to a particular investment. Now, there aren't a ton of investment funds that charge more than that, but there's a good amount that still do annually, which is, okay, I don't even want to get any investment fund that charges that high is usually doing so because they're paying individuals to pick stocks, and they have strategies that they think, hey, we know which stocks are going to do better, or we think that we do, for either technical reasons, because of like statistics that they work with, or because of fundamental reasons, which is in reference to the market share of a company and their projected growth that could be achieved within the confines of the known economy. So those are fees that are paid to professionals who are picking stocks. Whereas like what you mentioned, Chad, about like Vanguard index funds, those tend to be closer to like 3 to 8 basis points or bips. So those are much, much cheaper. You might even be like your 403B plan, depending on how large your institution is, they may have access to higher economies of scale oriented index funds. So Vanguard will make available, like, what is it? The VIIIX.
Yeah, the plus shares, right?
Right. And that is like one of the institutional versions of VTSAX. And the difference is it's a little bit cheaper because the plan has enough employees that are investing in it that Vanguard has a relationship where they say, okay, we're going to give you this bigger institutional fund that is 2 basis points instead of 3. And so what that means is that for every $1,000 that you have invested, it's going to cost you, is it $2 or is it 20 cents? I think it's 20 cents.
20 cents, yeah.
Yeah. 20 cents.
I hope we both agree on 20 cents. If we're wrong, our channel's going to plummet.
Get out your calculator, man.
I don't even know where my calculator is. We'll check it and put it in the show notes.
So 20 cents on a $1,000 investment is pretty low, as opposed to if you're doing 1.5%, that's going to cost you $15. So, $15 doesn't seem like a lot, but if you compare that $15 to 20 cents, and then you're not investing $1,000, but you're investing $1 million, the numbers are going to start to add up. So when it comes to investment choices and costs, you don't always want to just be going for the cheapest overall approach. But a lot of investment funds and vehicles have lower cost now because I don't like using the word passive because investing is never passive, but you're investing in funds that are not being micromanaged by professionals that think that they can outsmart the market. And as a result, it is less expensive to own. And they follow the stock market. And so those tend to be very good options to consider. But of course, to each their own.
Yeah, I mean, it's the difference between you buying the S&P 500. So again, also trying to add in like basic concepts here. When you turn on the TV, there's usually 3 that are listed. You got your Dow, you got your S&P 500, and you got your NASDAQ. The Dow, which is the most heavily quoted, is actually probably one of your worst indicators because there's 30 stocks in there. It's actually not a good indicator of the market per se. NASDAQ is very tech heavy, so also not your best indicator of the market. S&P 500 is actually your better broad market indicator, right? So the S&P 500 index fund is going to track that index. So it's saying, I want to track, for the most part, US large caps and mega caps that we assume that they're going to do good. Compared to you trying to say, well, I actually think this one company inside of the S&P 500 is going to outperform. Maybe you're right, maybe you're wrong, but this is what we're saying. And again, coming back to our favorite word of the day, simple, keeping it simple, where I'm okay owning all 500 and kind of going with the flow of that index. Now, maybe you don't like that index. Maybe you do like the idea of tech. So maybe you do more in the NASDAQ, but you don't have to overcomplicate it. And I think physicians in particular, we talk about work-life balance and where can we delegate and remove complications. I think investing is one of those. And as our clients get more and more net worth, they'll usually come to us and they'll say, well, what else can we do? And obviously there is other things that you can do. But to this day, one of my favorite things is having, a couple $1 million, and you look at it, all it is just some beautiful built buckets. I call different accounts buckets in index ETFs. It's simple. It's beautiful. It's not complex. Something beautiful to that. And I think that's something to keep in mind where, when you get into those higher numbers and kind of add in whatever you would plug in there, you don't have to make it more complicated. If anything, keep it more simple, keep time on your side, keep complexity out of it. And you should be in a good spot in the long run here in investing. And, I know, Tyler, we're keeping this very high level, which this many weeks into it, we covered Roths in a topic or two, but investing is one of those ones where we can go a million different ways and we want to go a million different ways. So continue to either drop us comments in the YouTube video or head it over to the website, physiciansense.com, and then adding them in the Google form. But investing, it will build on this a lot of ways, but your questions can also help guide that. What would you close up with, Tyler?
I would say that because it's so beneficial to invest as early as you can, that whatever path will allow you to get started is better than not getting started at all, unless we're talking about being sold like an insurance sort of a strategy. I have to say that, unfortunately. So if you're an intern this year, your sources of investing are your program's 403B or a personal Roth IRA. There may be other investment opportunities out there, but by and large, they are not relevant, or at least relevant enough to need to talk about here. So your 403B through your employer, you can pick the target date fund, or you could pick a few of the index funds that are in the plan. And it runs through your payroll, so that's very convenient. So it just gets taken out of your paycheck. If you want to invest in a Roth IRA, you can do that through Fidelity or Schwab or Vanguard. You just open up an account and then you fund it with money from your checking account, and do the same thing if possible. Just automate a modest amount to get started. You want to find the path of least resistance to get started as early as you can. And then for those of you that are, finishing training soon, or you are out of training, you've got to do more than that. You've got to get going. The opportunities for physicians to be able to create wealth that can subsequently allow you to create decision freedom, it is there, but investing as early as you can is critical. And, you all know better than we do. You're the earliest that any of you are earning your post-training check is like age 29. And that's very much an outlier, because many of you are in your 33, 36, 39, 42 before you're really earning a paycheck, and you've got to get going. So you need to address your investment decisions and plan as soon as possible. So if you're in training, get going early with modesty. If you're out of training, you got to get going and you got to knock it out of the park and max out your retirement accounts at work, because time is super important to investment success. And yeah, we'll dig into other details too about, investment strategy and tax efficiency in the future. But take this as your sign to get going as soon as possible.
Yeah, well said. One of those things where it's not an all or nothing either. Just get started. It's 2%, 3%. If your employer offers a match, we say that's low-hanging fruit. At least get the full match. We're not going to get into strategy on this one, but if you're listening, like, 403B, I just heard of this thing. Oh, they offered 3-4%. That's free money. Go get that. And, you got to at least put in if they say you got to put in 4% to get 4%, that means, you got to get in your 4% to get their full match. Sometimes they'll have weird ratios, like 100% for the first two, and then 50. They make it more complicated than it needs to, but that should be a simple question to HR. I trust HR on that one. In defense of HR, they get bombarded with a lot of difficult things, but that's one that they should be to help you with easily. But just get started. That's the key. Set good precedents, get things organized. And if you're watching this in training, then you can easily increase those numbers once you become an attending. If you're watching this as an attending, for most, I know Tyler just said it, 403B should likely be maxed out, no questions asked. A backdoor Roth should be maxed out, no questions asked most of the time. You're probably starting to dabble in a taxable account. So if you're watching this, you're saying I have questions, like I said, YouTube comments, the website has the Google form on it. But that's enough dabbling for now, Tyler. We're going to leave it there for investing. Literally, we have built careers on this topic. So one 30-minute podcast just is literally that very, very, very top, like air bubble layer. We're not even into it yet. So thank you, my friend. I'll catch you on the next video here, on the next recording, and we'll take it from there.
Sounds good. Have a good one.
All right. Thanks, Tyler.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state-registered investment advisor.